The world of medical innovation is a constant, complex race.
It really is. It's where you see technology meet humanity, and the stakes couldn't be higher.
Right. We're talking multi-million-dollar imaging equipment, cutting-edge AI software, and highly specialized diagnostic drugs.
Exactly. And when you look at the global landscape of who actually builds these foundational technologies, the massive CT scanners, the MRIs, the surgical guidance systems, you find that only a handful of players really dominate the market.
And today, we're doing a deep dive into one of those major global players, GE Healthcare Technologies, Inc., or GEHC for short.
Yep. And for this, we're grounding our analysis in a recent comprehensive research report from the firm Compasscope.
And we're pairing that with the company's very recent Q3 2025 earnings update to get a full picture.
So our mission today is to quickly unpack how GEHC is structured, understand its position in what is, an oligopolistic market defined by innovation, and highlight the key drivers and some pretty significant geopolitical risks that you need to be aware of right now.
Okay, so let's start with the architecture of the business itself. Let's unpack this.
Sure. So GEHC calls itself a global medical technology and digital solutions innovator.
Which basically means they're the architects of a modern hospital's technology core.
That's a great way to put it. They're largely focusing on diagnostic imaging, software, and, crucially, the services that keep all those complex machines running.
And their structure really defines where the revenue comes from. It's built on 4 distinct pillars.
Exactly. The biggest, accounting for about 45% of total revenue, is imaging solutions.
Okay, so that's the powerhouse segment.
It is. This is all the big-ticket equipment. X-ray machines, high-end CT systems, sophisticated MRIs, and molecular imaging systems like PET air and SPECT scanners.
So nearly half the company is in those massive machines. What's next?
The next major segment is advanced visualization solutions, or AVS. That's about 26% of revenue.
And this is more specialized stuff.
Right. This is where you find their global ultrasound portfolio. So everything from handheld point-of-care devices to dedicated women's health systems, plus the procedural guidance tools used during surgery, things people often call C-arms.
Okay. Then you have the smaller but still vital segments.
Yep. Next is patient care solutions, PCS, at 16% of revenue. This covers the acute care environment.
So things like anesthesia machines and patient monitors.
Anesthesia delivery, patient monitoring equipment in the ICU, vital signs monitoring. But what's really important here is this is also where their digital offering lives.
You mean platforms like Care Intellect?
Exactly. It operates as a real-time analytics subscription-based SaaS solution.
And that leaves the final piece, which is arguably the most unique.
I would agree. It's Pharmaceutical Diagnostics, or PDX, at 13% of revenue. This is what truly sets them apart from their hardware-focused peers.
Because this isn't equipment at all.
Nope. This is all about consumables, specifically contrast media, the dyes used to enhance imaging results, and specialized radiopharmaceutical tracers used in nuclear imaging.
And what's fascinating is how these 4 segments create this powerful, this stickiness factor.
That's the key. Roughly 50% of GEHC's total revenue comes from recurring streams.
So you don't just sell a machine once.
You don't. You generate multi-year service contracts, continuous software licenses, and you have that constant demand for consumables like contrast media and those tracers.
So if a hospital delays buying a $5 million MRI this year because of budget pressure,
GEHC doesn't go broke.
Because half its revenue is coming from servicing the machine it sold 5 years ago, or from the continuous flow of PDX contrast media that's needed for every single scan.
Right. That recurring base provides significant revenue stability during the typical capital expenditure or CapEx downturns that always plague the healthcare hardware industry.
And that stability is essential because when we look at the competitive landscape, this is not a fragmented market.
Not at all. This is a global oligopoly.
So when you look at the global medical imaging market, it's really GEHC, Siemens Healthineers and Philips.
And together, they control about 70% of the market share.
Which means the competition is less about price wars.
And much more about high R&D investment and innovation. Pioneering new technologies like photon-counting CT systems.
And that market structure gives GEHC a huge competitive advantage.
It's built on scale and intangible assets, decades of reputation, the sheer breadth of their portfolio, and critically, very high switching costs.
I mean, think about it. Once a hospital has integrated these massive pieces of hardware, All the specialized software, the training.
Changing vendors becomes extraordinarily disruptive and expensive. It's like trying to switch your entire hospital's operating system overnight.
A Herculean task.
It is. And GEHC leverages this scale to act as a one-stop shop for large hospital networks. They're definitely backing this up with serious money, too.
The R&D spend was $1.6 billion in 2024 alone.
A huge number. But the true differentiator, as we touched on, is that integrated strength in pharmaceutical diagnostics.
In the PDX segment.
Right. Siemens and Philips are giants in hardware, but GEHC's PDX segment, especially its exposure to the theranostics market, gives them a really unique position.
And for anyone who might not be familiar, theranostics is where things get genuinely futuristic.
I mean, it really is. It's the combination of diagnosis and therapy.
Using the same molecular agent to first find the disease, like cancer, and then
deliver a targeted therapy to treat it. It's a convergence of two massive fields, and because GEHC already dominates the contrast media and radiopharmaceutical space, they are just perfectly positioned to capitalize.
But they aren't immune to macro forces.
No, absolutely not. They're inherently dependent on hospital capex, and then there are the significant geopolitical risks.
And the Compascope report really highlighted this. The U.S.-China tariffs are projected to be a huge headwind.
A huge headwind. A 45-cent adjusted EPS headwind for 2025. That is a massive chunk of their projected earnings just being eaten away by trade friction.
And that's compounded by local competition in China.
Yes. Domestic suppliers like Mindray are gaining share because the Chinese government has been increasingly protectionist, favoring local vendors.
So if we quickly stack them up against their peers, Siemens Healthineers is the closest comparison.
For sure. Closest in scale and portfolio, they lead in some of the most advanced tech, and they diversified heavily into oncology with that massive Varian acquisition.
But again, Siemens lacks that integrated PDX strength.
They do. Then you have Philips, which is strong in health informatics and connected care, but they have been severely handicapped
by major operational challenges, the product recalls.
The recalls have significantly strained their reputation, drained their cash, and created deep uncertainty around their ability to execute.
And then there's Mindray.
The localized threat. They have cost advantages and favorable policies in China, but they just lack GEHC's global scale and technological depth outside their home market. The balance across GEHC's 4 segments gives it resilience.
Okay, so that structural resilience leads us directly into their growth strategy. Setting aside those immediate challenges, what's the long-term blueprint for growth?
The strategy is really designed for sustainable, diversified growth built around 3 clear pillars.
And the first is just relentless innovation.
Right. This is all about maintaining market leadership. So focusing on next-gen products, AI-enabled imaging, their own photon-counting CT systems, continuous MRI upgrades.
The second pillar, and this is probably the one with the highest potential, is PDX and theranostics.
I agree. This is about capitalizing on their unique position in radiopharmaceuticals to aggressively target that $40 billion theranostics market by 2027. They have a structural head start there.
And the third pillar?
Digital solutions. The heavy investment in AI and SaaS platforms like Care Intellect is designed to fundamentally change their revenue mix.
By pushing for more subscription-based recurring revenue.
Exactly. It optimizes hospital workflows, shifts revenue to higher margin sources, and deepens their integration into the whole hospital ecosystem.
Now, the Compascope research described GEHC's strategy as more balanced compared to Siemens. What does that mean in practical terms for you?
It really just means lower execution risk. Siemens' growth is so highly reliant on the successful, timely, and frankly complex integration of Varian into their oncology business.
That's a huge high-stakes project.
It's a multi-year integration. If that falters, their growth takes a big hit. GEHC, by contrast, is spreading its bets across hardware, diagnostics, and software. They don't have that same single point of failure.
Okay, that comparison of risk brings us to their own specific execution challenges. GEHC was spun out in late 2022. That's a massive transition. What other risks stand out?
Financial flexibility is a key concern. They're not exactly swimming in cash compared to some competitors. They operate with moderately high leverage and net debt to EBITDA ratio of 2.5 times.
And that's combined with significant unfunded pension obligations.
A total of $4.6 billion. And that, together, constrains their ability to make aggressive, Varian-sized acquisitions.
Wait, hold on. If they're carrying that much debt and a $4.6 billion pension burden, Why did the research suggest they had the lowest execution risk among their major peers? That sounds like a pretty big vulnerability.
That's a great question, and it speaks to the difference between operational risk and financial constraints. The operational risk, so the risk of product recalls, manufacturing failures, major business collapses, that's low because of their diversification and stability.
I see.
But their financial constraints limit them to smaller, focused tuck-in acquisitions, not those transformative mega deals. So the stability protects them from sudden operational shocks, but the debt restricts their maximum ambition.
And that R&D dependency is a double-edged sword, too.
For sure. All that investment in photon counting CT and theranostics only pays off if they commercialize them successfully and quickly enough to stay ahead.
They have to keep running in this race.
Precisely. But the overall conclusion remains. The market rates Philips as the highest risk due to the recalls, followed by Siemens with the Varian integration risk, leaving GEHC as arguably the most stable operator in the large-cap medtech imaging space, despite those balance sheet constraints.
All right, let's transition now to their recent performance, because that stability seems to be reflected in their latest Q3 2025 financial update. What did the earnings call tell us?
The momentum is strong, especially on the demand side. Organic revenue grew 4% year over year, which is solid, but the order book is even stronger.
Organic orders grew 6%.
Which is critical because it drives their backlog up to a very healthy $21.2 billion.
And when we talk about a strong order book, we always look at the book-to-bill ratio.
Absolutely. Their book-to-bill ratio was 1.06 times. For listeners, that just means they're booking 6% more business than they're actually fulfilling or shipping. It's a clear sign of robust forward-looking demand. And despite that huge geopolitical headwind you mentioned, the 45-cent tariff drag, they actually raised their EPS guidance for the full year.
They did. They raised the lower end, now targeting $4.51 to $4.63 per share. It really suggests that underlying operational strength is offsetting those external costs.
And that's where the margin story is crucial, because it needs a little context.
It does. The adjusted EBIT margin was 14.8%, which looks like a drop. It was down 150 basis points year over year.
So why did it drop? Was it just the tariffs?
It was almost entirely the tariffs. Management specifically said the $95 million tariff impact in the quarter caused most of that decline.
And if you exclude that?
They stated that excluding the tariff impact, the underlying margin would have actually expanded by 30 basis points.
Yeah.
That's a powerful sign that their core operations are improving, even while external forces are masking that progress.
And they're working to fix that for next year.
Yeah, they're actively working on supply chain mitigation efforts to lower that net tariff impact in 2026. Now, looking at the segments, AVS, the ultrasound and procedural guidance part, was a real bright spot.
AVS organic revenue was up 6%. This was the fourth consecutive quarter of year-over-year sales and margin growth for AVS. This is where you can see that R&D investment paying off immediately.
Driven by new AI-enabled products.
Exactly. Strong adoption of things like the Vivid Pioneer and Alia Pulse.
On the other hand, Patient Care Solutions, the PCS segment, struggled a bit. Revenue was down 7%.
That decline was mainly temporary, though. It was caused by a product hold a specific issue that has now been resolved and shipments have resumed.
And they brought in new leadership there.
They have. The focus now is on sharpening commercial execution and improving margins in that segment, with an expected rebound in the fourth quarter.
Okay, let's talk about the PDX segment and that crucial launch of the radiopharmaceutical, Flyrcado. Sales grew 10% organically, which is great, but the launch itself was slower than expected.
Right. It missed the $30 million target for 2025, but this is a case where that might actually be a good thing.
How so? Isn't that a strategic mistake?
Quite the opposite. This is a rare example of management prioritizing long-term market dominance over short-term revenue.
So they slowed it down on purpose.
Deliberately. They wanted to prioritize the customer experience and ensure supply chain consistency. They were aiming for a guaranteed supply yield of 95% or better before they aggressively pushed the product out.
Because a botched launch in radiopharmaceuticals could do permanent damage.
It could permanently damage customer relationships, but the long-term potential remains massive. The $500 million revenue goal by 2028 is reaffirmed.
And they pointed out that converting just a quarter of the existing market
would generate a full $1 billion in annual revenue. And they just signed a key distribution agreement with CardioNovics, which should really accelerate that market conversion.
Finally, what about the crucial China market?
Management expects sales there to be lower in the second half of 2025 due to that localized competition and protectionism. But they remain confident in their mid-single-digit long-term growth targets.
They don't see a permanent problem there.
No, they said they see no structural reason preventing China from eventually returning to growth. They believe their technological superiority will ultimately win out.
Which brings us to our keys to watch. If you're tracking GEHC's story, there are a few factors of high uncertainty and high impact that require ongoing monitoring.
Number 1, R&D execution. The successful, timely rollout of these new technologies, photon-counting CT, the theranostics solutions, is just non-negotiable for their future growth.
They have to deliver on those investments.
They have to. Number 2, geopolitical risks and tariffs. We have to keep watching their ability to mitigate the ongoing U.S.-China tariff costs and maintain market share in China.
And number 3,
adoption of AI and digital solutions. Monitoring the pace of customer uptake for new SaaS platforms like Care Intellect is crucial. This is how they shift to higher margin, predictable, recurring revenue. If adoption is slow, the transition will be painful.
So to summarize, GEHC is a structurally strong player in an oligopolistic market. They're cleverly leveraging a balanced portfolio of hardware, diagnostic software, to offset these macro and geopolitical risks.
And their innovation investments are already starting to pay clear dividends, especially in that AVS segment. We've established they are, the most stable operational boat in a choppy medtech sea.
And they're investing heavily in digital solutions like Care Intellect to optimize specific clinical workflows.
But given that hospital capital expenditure cycles remain a persistent and really an unavoidable risk to their hardware sales, here's the final provocative thought for you to consider.
How quickly will GEHC's AI and SaaS solutions evolve to move beyond just clinical optimization and start fundamentally transforming hospital management and capital allocation?
If they can develop digital tools that make large imaging purchases less cyclical and more predictable globally, maybe by guaranteeing a measurable ROI or utilization rate, that's where the true opportunity to unlock long-term structural value really lies, beyond just selling the next machine.
Thanks for joining us for this deep dive into GE Healthcare.
We'll catch you on the next one. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.